Okay. Uh, Good evening, class. Now we will be actually proceeding with the central banking and the conduct of monetary policy. And in this class, we were actually going to talk of the conduct of monetary policy, transmission mechanism of monetary policy, flexible price economies and monetary policy, and Lucas supply functions and the effects of monetary policy. So let's start with the conduct of monetary policy, the strategies. Now, there are four basic types of monetary policy strategies. First is that it's the exchange rate targeting. That's the first. Exchange rate targeting, that's an effective means exchange to control inflation, both in it can be done very quickly, both in industrialized as well as emerging market economies, right? But what happens is exchange rate targeting, it results actually in the loss of an independent monetary policy. And it also, what does it mean? It also means that shocks, there are shocks which are aimed to the, which is being related to the anchor country, to whose currency, the domestic currency is pegged in, right? So that is being transmitted to the targeting country. Why? Because what happens up here is the domestic interest rates are determined by the anchor country. When we talk of the exchange rate, that is, exchange rate is the price of the domestic currency in terms of the foreign currency. So we so the money, the domestic interest rates, because that's why they are determined by this anchor country. That's a foreign country against whose currency we are actually, against which we are the domestic currency is pegged in, right? So it, so the there's a, the monetary policy of the nation actually starts losing its independence. That happens. Second is monetary targeting. So what happens up here is central banks actually uses this instrument to control the monetary aggregates, right? Which are the main factor for factor which determines inflation in the long run. Third is inflation targeting. So here what happens is the monetary policy actually provides a nominal anchor to the economy. Now, what is a nominal anchor? It's a variable which policymakers can use to tie down the price level, right? One of the nominal anchor that central banks used to in the past was currency peg. Currency peg, where the value of the domestic currency is tied up with the value of a low inflation country. But if you actually go with this approach, it means that the monetary policy of the country is active, which was it was essentially like a is tied up to the country to which it is pegged, so it's no more independent, and it actually puts a constraint on the central bank to respond independently to any changes that comes up in terms of the terms of trade, right? Terms of trade is the value of a country's exports in terms of of its imports, or if there is a change in the real interest rate. So it becomes very difficult if it's tied up, it's pegged in. So as a result, what happened is like countries today have started to adopt flexible exchange rate, which helps them in finding a new anchor. Fourth is monetary policy with an explicit goal, but not an explicit nominal anchor. So where it talks about controlling inflation in the long run, along with that, it also involves forward looking behavior whereby there is careful monitoring for signs of future inflation, not just controlling inflation, but monitoring any signs of future inflation, along with periodic preemptive strikes by the monetary policy against the threat of inflation also. So monitoring the controlling the long run inflation, monitoring signs of future inflation, and also intervening against any threats of inflation. Okay, now achieving the monetary policy objectives, it requires that there has to be a consistent monetary policy framework. which is really needed. It's become necessary also. Why? Central banks is their main objective is to main target is to achieve these objectives uh, through the instruments, with the help of instruments which are under their control. So there has to be a proper policy framework with the help of which the central banks can achieve these objectives. Say, for instance, under the monetary targeting framework, central banks use some of the instruments which are under their control, that is CRR, reserve ratio, uh, which is used to influence the money supply, which actually leads to, this is an intermediate target, which can ultimately lead to achieving of the final objective, that is price and stability of price and output. So they can do that, right? Monetary policy framework, however, has been a continuously evolving process, which is based on dependent on the level of development on the financial markets and institutions, and also on the degree of global integration. And so this is why monetary policies across nations have undergone significant transformation over time. Now, for effective implementation of monetary policy, what needs to be done is monetary policy needs a supporting operating procedure. It is needed. Now, what is an operating procedure? It's a day-to-day management of monetary conditions, which is consistent with the overall objectives of the monetary policy. So, what does it involve? It involves defining an operational target. Usually, it's the interest rate. Target is the interest rate. Then, setting a policy rate which could influence the operational target. Thirdly, setting the width of corridor for short term interest rates. What would be the short term interest rates? Then, conducting liquidity operations. How much money to be there in the economy in order to keep the operational target interest rate stable, how much money should be there so that the interest rate is stable. And finally, price intentions. Okay, so the general norm of central banks is to have a short term interest rate as the operating target, while using the liquid management interest instruments to control the liquidity conditions, so as to control the operating target. So their main target for central bank is to have a short-term interest rate. That should be their operating target. How? Using the liquidity management instrument to actually regulate the liquidity conditions, which would help in controlling this the operating target, that is the interest rate. What should be the total amount of money? That is the liquidity management instrument. They use that to control the amount of money which is there in the economy, which should be there to, which would help in achieving the interest rate, the desired interest rate. Okay, now the key to the operating framework, as we said, is the liquidity management, right? So, liquidity management, which actually ensures controlling of the reserve target, how much, what should be the level of reserve. It ensures the first phase of monetary policy transmission, where it talks where it's relating the short-term money market rates to the policy rate target, prevents disruptions in payment and settlement, and especially with regards to liquidity deficit systems. What are the non-monetary instruments? There are some non-monetary instruments. One is the regulatory measures, which is selective credit controls, which is ranging from improving the credit culture. When we say credit culture, that is to establish credit bureaus, credit registry, higher risk weights for sensitive sectors, supervisory measures, that could be on-site or and off-site inspection of banks, and moral suasion. The second type of non-monetary instrument is financial measures. So, working there where they work their way through the foreign exchange market. How? By liberalizing and restricting capital flows, intervening in the foreign exchange market, reserve requirements on the foreign currency instruments, how much is required in the, or how much foreign currency is required. Third is macroprudential measures. Now, what is macroprudential measures? It's an approach to financial regulation that aims to mitigate the risk to the financial system as a whole, or systematic risk. Now, what is systematic risk? We've been discussing. It's the vulnerability of events which affect aggregate outcomes, such as broad market returns, total economy wide resource holdings, or aggregate income. So, these are also macroprudential measures are designed to contain the systematic risks. Okay. Next topic that we have is transmission mechanisms of monetary policy, right? What is transmission mechanism? It's a process by which monetary policy decisions affect the economy in general and of economy of, in total, and especially the price. So, in theory, what we have is like a given it's the central bank has its monetary total power in issuing money, monopoly power. So, given that power, central bank can fully determine the interest rates at which it provides funds to the banking system, and this in turn influences the bank lending and deposit rates, as well as other variables, that is exchange rates and asset prices. Now, the monetary policy decisions also affect the expectations about inflation in the future. Interest rates, asset prices, exchange rate expectations, they all have in turn have an effect on the savings and investment decisions, the credit on the supply of credit, and ultimately on the aggregate demand. When aggregate demand as a increases and exceeds more than aggregate supply, this actually leads to what? It puts an upward pressure on prices, and reverse happens when aggregate demand is less than aggregate supply. So, in practice, what happens is the transmission mechanism is a complex mechanism of economic interactions. But it's difficult to quantify the exact effect of monetary policy decisions on the economy and the price level. Okay. Now, given the lags in the transmission process, there is a lag. Okay, the monetary policy, there's a time lag. So, monetary policy changes made today will only affect the price level after months or even years. Change in monetary policy does not affect price level immediately. There's a lag, time lag. So, what this means, what that monetary policy must be forward looking. Banks should actually think of a policy which is needed at present, which would help in maintaining price stability in the future. Also, given the present complexity, the complexity of the transmission process, there is always a great degree of uncertainty surrounding the timing and the size of adjustment, which is triggered by changes in monetary policy. It's always there. So what happens is, so the best thing is to there should the monetary policy, like there should be a medium term orientation to monetary policy. That is the best. That should be that is desirable to actually avoid any sort of excessive and unnecessary volatility in the real economy. Right. So what are the channels of transmission of monetary policy? First is direct interest rates. Direct interest rates, which affect not only the cost of credit, but also cash flows of debtors and creditors. Changes in interest rate will affect the marginal cost of borrowing, that happens, which leads to changes in investment and savings, and therefore on the aggregate demand. Right. Will so the changes in average interest rates will also have cash flow effects on borrowers and lenders, like how much money to lend, how much to borrow. That has an effect. Second channel is impact of monetary policy on domestic asset prices, which includes bond, stock market, and real prices. Okay. Okay. Third is exchange rate, we explained. Fourth is credit availability. So we know this also. So countries which are either poorly developed or they have a tight controlled financial systems, interest rates may not move to clear the market, right? Aggregate demand is generally it's influenced by the quantity of credit. Amount of credit is there, that not through price. So even in a highly developed market, credit changes operating in addition to the interest rate changes. uh, they have been identified as important factors which affects the economic activity, right? So an increasing body of research has found that the research has been done, and so it has been found out that the financial conditions of households, firms, financial institutions, they play a key role in the way the monetary policy should be put into actions, right? How these channels function in a given economy, it depends on its the financial structure and the macroeconomic environment. It depends, right? Okay. The next topic is flexible price economies and monetary policy. When there is flexible prices, it makes the marketplace more efficient, right? And which can be certainly it can where it can be realized or where you can achieve your targets, right? So when prices change constantly with changes in supply and demand at little cost, buyers can more easily find the price at which they are willing and able to buy. So if it's fixed price, then what happens? They have a choice. Buyers have a choice either to pay too much, paying too much, or just go away with it. Okay, without that's what happened. But now what happens with flexible prices? So it's a game of waiting to be notified when the right price comes along and then take it. Similarly comes with the help from the point of view of sellers. So they can actually practice today perfect price discrimination by charging different price for different customer and each item. So this flexibility in the price is actually it's particularly useful for perishable goods like airline seats, advertising time, long distance phone minutes, electricity. And because price changes can be quickly and cheaply communicated to the potential buyers, sellers can afford to wait before lowering prices for a massive sale. Okay, then continuing with the flexible price economies and monetary policy, the commodity prices that will actually increase, that will go beyond the equilibrium levels uh, in response to a monetary policy shock. Why? So what happens? There is a decline in the real interest rates. What will happen? It will increase the commodity prices above the equilibrium in the short run, because people will start demanding more money, and so then they will actually demand, aggregate demand will start increasing, and so but the quantity of products that's manufactured, that's limited, so the prices go on. So as a result, what happens? Firms build up inventories, new investment projects, and becomes profitable, and thus increasing the commodity supply, while simultaneously demand for commodity futures decreases. Supply starts increasing, so the demand for commodities goes down, because what people feel is price is above the equilibrium. So that's how, and during this correction, what happens? The aggregate price moves in the same direction as the movement in the commodity prices. So price level starts moving in the same direction, and ultimately, what happens? Equilibrium is attained once more. Commodity prices increases, demand for commodity increases, prices go up, so aggregate price level also goes up, right? So there are three fundamental determinants of commodity prices. Firstly, since many commodities are inputs in the production process, so both demand and prices usually decrease the global economic activity. so less people will actually buy it. Second factor is the exchange rate. Why? Because commodity prices are usually denominated mostly in US dollars, and commodity exporters, they have an incentive to stabilize their income and raise prices when the dollar value is less, right? Also, a depreciation of the dollar means what? Lower commodity prices in the local currency, and which ultimately results in a increase in demand for such goods, which results in increasing the prices. Third factor is the monetary policy and its effect on prices. Lower interest rate, what happens? It decreases the incentive to extract today, increases the incentives to maintain inventories, and stimulate the demand for domestic commodity derivatives. They will be suppliers are going to hold it. Wait. So what happens? Demand increases, and so which actually leads to rising in the prices of the basic products. The last topic that we have is Lucas supply function and the effects of the monetary policy. According to Lucas, when policies change, public expectations will shift as well. And such changing expectations can have a real effect on the economic behavior and outcomes. This changing expectation was ignored by the conventional econometric models. And the effects of a particular policy depends on the public's expectation about the policy. So if public expects that the rise in short-term interest rate is going to be only temporary, so then what happens? The response for long-term interest rates will be negligible. But if the public expects that the rise in the interest rate to be more permanent, then the response of the long-term interest rates will be much greater. So, what Lucas points out that not only that conventional econometric models cannot be used to for policy evaluation, but also that public's expectation about a policy will influence the response to that policy. So these are the two things that he had to say. Now, according to Phillips Curve, one could achieve and maintain permanent low level of unemployment. How? Merely by tolerating a permanent level of inflation. If you can tolerate a high level of inflation, then the unemployment level is low. So, in case of Phillips curve, what happens? The cost of reducing inflation. How can you reduce it? By it's measured by the sacrifice ratio. That is, what should be the percentage of GDP that has to be decreased to what or foregone to reduce inflation by 1%. Like if you what will be the percentage of GDP that has to be foregone, opportunity that you have to lose to reduce inflation by 1%. But these estimates of sacrifice ratio, they are often like quite large, and that's why some of the economists have actually argued that policymakers, it's better to learn to live with inflation rather than incurring the large cost of reducing it, because if you start reducing inflation, there has to be the GDP has to be 1% reduction in inflation leads to huge the percentage of loss of GDP is quite large. So according to the experts, or as we say, advocates of rational expectations approach, okay, what they feel is that these estimates of sacrifice ratio are unreliable because they are based on expectations, right? Someone's your expectations. So it's not they are simply implying some systematic errors in they imply systematic errors in forecasting because you're expecting, and it does not take into account of other relevant information. It's your expectation which actually implies that can be some systematic errors, like it may or may not be correct, and you don't if you and it's you do not have the relevant information. You have to take into account the relevant information which is not being taken. So in the early 70s, now what happened was uh, Robert Lucas Jr., he developed an alternative theory of Phillips curve and the money driven business cycle. using the assumption of rational expectations, where he showed a positive relationship between between output and inflation that could happen because of imperfect information regarding the aggregate price level. Lucas supply function, it says it implies that only unanticipated changes in money supply affects the real output. When there is an anticipated change in money supply, it affects only price level, while and leaving the real output equal to the potential at the equilibrium. Okay, when you expect a change in money supply, so some there will be a change, parallel change, proportional change in price level, and equilibrium comes about. Only when unexpected changes come about would there be ultimately the real output gets affected. And there are two crucial assumptions in this. One, prices and wages are perfectly flexible. And secondly, expectations that you have that is totally rational, right? So, but if prices are sticky, does rigid, that means what? Anticipated changes money supply can have an effect on the real output, even if when your expectations are rational, that can have. So, what are the assumptions? First is microeconomic foundations. Microeconomic. So, in this model, it basically explains the departures of actual GDP from potential GDP. What is the gap between actual and potential, what it can be achieved, economy can achieve, using the microeconomic theory of firm supply. Said that prices and wages are assumed to be flexible. So, according to the microeconomic theory, firm produces up to the point where price is equal to marginal cost. And marginal cost, it depends on the price of the inputs, firm's inputs, that is used for production. Firm will produce more only when its price of its output increases relative to some other prices in the economy, especially to its input prices. When the price of output is more than the price of inputs, then only it'll increase its it'll produce more. When the general price level increases, especially when we have a boom situation, it does not actually change in the relative prices. So firm's output will not rise relative to its input price in such a case. So it's a general boom happening, general price level, it will not happen. It's nothing to do specific with the firm's price, firm's output. So how do we explain the boom that usually occurs when the general price level rises? To actually generate the price output relation, what do we have to do? We have to add another, there has to be another assumption about the information available to different firms that we have to take into consideration, which is imperfect information. Firms are assumed to have difficulty getting information about prices in the economy other than their output prices. And there are temporary information barriers which firms cannot see what is going on in the other markets. So therefore, what happens, firms tend to have confusion in the movements of the overall price level with the movements in relative prices. So when there is an unanticipated inflation, it actually, what happens, individuals will actually infer that the relative prices of goods that they produce are temporarily high. So which will actually lead to induce them or encourage them to increase the quantity supplied. So which means that output depends on the deviation of inflation from the expected inflation. What should actually the inflation, expected inflation is, what is happening, unanticipated inflation. Third is rational expectations. So what Lucas said, that the issue of how people form expectations of the future, okay, and that's what he spoke here. So expectation theory, it plays a very crucial role in any economy. Why? Because they are the ones which influence all types of economic behavior. Households decide how much to consume based on the expectation of future income. Firms decide how much to invest based on the expectation of future probability. So these expectations actually depend on many things, including the economic policies that will be pursued by government. So Lucas had to say that the traditional methods of policy evaluation do not adequately take into account this impact of policy on expectation and thereby on the behavior. So the model has two types of shocks. That's also there. Uh, what are these? First, a random shift in the preferences that change the relative demand for different goods. When there's a random shift, so these shocks actually lead to changes in relative prices and the relative production of different goods. Second type of shock is disturbance in the money supply. When this happens, they change the aggregate price level and have no real effects. But when these shocks are actually observed, but when they are unobserved, they change both the price level and the aggregate output. Okay. So, what was the conclusion of the what Lucas theory? Only non-anticipated aggregate demand shocks can affect real output. But however, anticipated and non-anticipated demand shocks both affects the price level. They will both affect the price level, but only non-anticipated aggregate demand affects the real output. Second, variance of price level depends on the variance of aggregate demand. So, for example, if there's a deviation in the output from its natural deviations in any output from its natural rate, it depends only on the unanticipated movements in the monetary supply. When there is anticipated movements in the monetary supply, they only affect the price level. Anticipated monetary policy has an effect on price. Why? Because with rational expectation, individuals take into account this policy. They look into it. They know that it's a rational. That's rational expectations. Okay. So the main implication of Lucas critic, what is it? Dynamic macroeconomic should be based on microeconomic foundations. Consumers and firm behavior must be derived from the dynamic macroeconomic models, where the response to changes in policy and other phenomena is determined by the policy invariant structural parameters. The changes in the parameters in the which are the factors which determines the policy. Second, policy evaluation must take the reaction of private sector into account. It should. Thirdly, it shows how a positive relationship can arise between output and inflation, even though prices adjust instantaneously and markets clear, right? And this positive correlation between inflation and output is not because of the sluggish price adjustment, but because of the unanticipated movements in the monetary supply, which initially affect output temporarily, but eventually it only causes inflation, right? So that's all that we have up here, right? So I'll see you in the next class.